Typically, when we talk about dividend stocks, some big names that come up are AbbVie, AT&T, Leggett & Platt, and 3M. But in this video, we're going to talk about some stocks you may have never heard of before, yet they are still very great companies. So with that being said, let's get started with this video. The first stock on this list is WP Carey, which currently has a dividend yield of 5.08% annually and has a ticker symbol of WPC. WP Carey is a REIT, or a real estate investment trust, which means that they invest in properties that are leased out through NNN leasing. So what is NNN leasing, you may ask? NNN stands for net, and it's basically an agreement made with the owner of the property and the renter. This agreement says that all fees, including taxes, insurance, repairs, and maintenance, must be paid for by the renter. WP Carey currently owns 887 properties in 17 different countries, with the majority of the profits coming from the United States of America. You probably wouldn't expect this company to have fast growth rates given their business model, but they actually have pretty fast growth rates for a real estate investment trust, with the revenue growing close to 17% year over year and expectations for the revenue to continue growing 15% year over year in the next 12 months. Their earnings have also been growing at a fast pace, as it's growing close to 19% year over year, but is expected to decline 8% year over year in the future, as they have recently been purchasing more properties in order to achieve higher earnings and higher growth in the future. From the surface, it seems like declining earnings is terrible, but it's actually a great move by their management, as it fuels more growth for the future. The fast revenue growth and the fast earnings growth that W. Carey has puts it at the top of the real estate and investment trust sector. So all this sounds great, but how steady is their dividend? Their payout ratio is quite high up right now, but their dividend growth still remains stable at 18 years of dividend growth and a 5-year growth rate of 3.85%. So overall, a pretty high payout ratio, but nonetheless affordable, as it's still below 100%. When it comes to value, WP Carey's value is decent right now, but not the best because the stock has recently went on a huge run. WP Carey currently has a PE ratio of 26 and a forward PE of 44, as they're focusing on expanding their business. The stock is currently up 23% in 1 year and 25% in 5 years. Overall, a very solid and stable business that can bring in dividend income easily. The next stock on this list is Main Street Capital, which has a ticker symbol of MAIN. It currently has a dividend yield of 5.98%, so pretty close to 6%. We often see companies with loads and loads of debt, and this debt is continuously increasing with interest every year. Some names that might have popped in your head include AT&T and Tesla. However, Main Street Capital isn't a company taking on debt. Rather than taking on debt, Main Street Capital is actually the one issuing the debt to other companies. Their focus is on issuing long-term debt to lower to middle market companies. So it sounds like a pretty stable business, right? But how do they rate against their competitors? When it comes to growth, they are above average, with the revenue growing 11% year over year right now and expectations for the revenue to grow 9% year over year in the future. These growth rates are far higher than the sector median, putting them at the top of their sector. However, their earnings are currently decreasing 4% year over year, but over the long term, it's expected to start growing again. This is because they are continuously funding new companies. In fact, we recently saw them fund Trantech Radiator Products with $15.1 million. So it's a pretty solid business, but how steady is their dividend? Main Street Capital's dividend has been growing for the past 12 years, which is pretty reliable, but their payout ratio of 95% is quite high up. Main Street Capital is currently up 8% in 1 year and 27% in 5 years, which is a decent price history for a high dividend stock. Their value is also decent, as their PE ratio is currently at 14 and the forward PE is at 15. Higher than the sector median, but not bad when you consider their fast growth rates. Now let's move on to the last stock on this list, Iron Mountain Incorporated, ticker symbol IRM, which has an insanely high dividend yield of 7.81%. The two previous companies were pretty stable businesses, but this one is more risky when it comes to price swings. Iron Mountain is a company that stores and manages data for over 225,000 customers. Some examples of data it stores includes home addresses and social security numbers. The earnings have been growing at an extremely fast pace lately, with earnings growing 92% year over year and expectations for it to continue growing at 19% year over year. So pretty fast growth there. Its revenue is not as fast, as its investments are just starting to pay off, with revenue growing 7% year over year and expectations for it to continue growing 5% year over year in the future. Iron Mountain's PE ratio is decent for a high growth company at 25, and its forward PE is close to 27. What is concerning, however, is their long-term debt, as they currently have $9.6 billion worth of long-term debt. That is a load of debt, as their current market cap is only at close to $9 billion. If the company's profitable growth plan plays out correctly, then they could be able to pay off their debt that way. However, that is a reach, which makes the stock such a risky stock. To top it off, their payout ratio of 150% is extremely high up, which makes it even more risky than it already is. However, it does bring a high dividend, and if you're interested with that, then this could potentially bring great returns. If you guys enjoyed this video, please subscribe, like, and comment. It really helps out with the channel. And as always, thank you guys for watching. I really appreciate your guys' support. And I recently got a new mic. Comment down below. Tell me how that mic is. With that being said, I hope to see you guys in another video.